Hello fellow traders, welcome to the latest weekly edition of As Good As Gold. I'm Dilin, research strategist at Pepperstone. Gold market sentiment is more towards the bearish side in the recent days as a result of central banks keeping interest rates higher for longer. In this video, I will go over some potential counterpart currencies that can be considered to trade against gold to make the most of the price action we've been seeing. And after suggesting some important levels that traders can keep an eye on, I will discuss the forces driving this price action and possible risk factors in the second half of this week. So if we firstly look at the overall performance of precious metals in the past 5 days, they have been losing ground against US dollar across the board. Palladium experienced the most severe loss, down by 2.8%, while gold is relatively resilient with a 1.5% drop. Moving to the daily chart of gold against US dollar, it touched the key lower limit yesterday of the range from 1900 to 1952 and is now struggling to stay above this support. As an important psychological level, 1900 is also the neckline of the recent double top pattern over the past months. If it breaks lower, it might find new support at 1884, the local low of mid-August. Apart from the obvious headwinds against US dollar, gold is still trading in the upward channel against some of the other G10 currencies, although the price pullback happened in the majority of the trading pairs overnight. If you are a gold bull, the Swiss franc would be the best trading vehicle. Gold against Swiss franc gained 8 times in the past 10 days, yet rejected the 61.8% Fibonacci retracement level of 1749 of the previous dip from early June to mid-August. Currently, the price is meandering around 1740. If it launches the second charge towards 1749 and succeeds, the next potential resistance can be found at 1754, last seen back to June. And 1731 can be seen as the nearest support. Gold against British pound is another pair worth watching if you want to buy low, which is still trading above the 10-day EMA and targeting 1584, the previous support level in March and April that turned into resistance in May. It is worth noting that most of these pairs are trading in a narrow range of about 10 points, which may suggest that the market is still digesting the new information added recently without really deciding the risk exposure. There are some potential factors that could drag the gold price lower. High interest rates are always the first thing that comes to mind. The US 10-year Treasury yield is 4.55% at the moment, a level not seen back to 2007. The Fed's hawkish pause last week is what has been pushing yields higher. The possibility of a November or December hike still exists, while the median interest rate projections indicate that the rate cuts next year will be reduced from 100 basis points to 50 basis point or so. The tightening cycle is yet to end, while the real rates are finding a cycle high at around 2.2% last seen in 2009. As a result, investors have started to reduce their gold positions to reduce risk after central bank bonanza. The Fed and ECB have reiterated their higher for longer policy stance, and because interest rates are expected to remain high has been priced in, the same applies to gold's holding cost. Meanwhile, the US equity market also failed to deliver. The S&P 500 slumped by almost 3% last week, while the Nasdaq performs even worse, dumping 0.3% more. Given the context of US dollar's impressive 10-week winning streak, taking the dollar as a hedging tool rather than gold seems to be a reasonable choice, and as a result, the gold price is lower. That said, there are still some factors that give gold bulls hope. Firstly, with China's gold binge extended to the 10th month as reserves climb, central bank buying led by China can be seen as a promising supportive factors of gold price. Another factor is investor expectation in regard to the US economic slowdown suggested by softer data from the labor market. Nevertheless, compared with the intrinsic value, gold premium in terms of risk-free rate is relatively high since the price still hasn't dropped to the price level where it should have been. When the reserve needs of sovereign countries decrease, gold can drop further, where the extent also depends on whether institutions decide to sell up if price touches new lows. In a nutshell, the gold is under pressure. High risk-free rate, fewer rate cuts, and strong US dollar performance under the higher for longer policy stance have all contributed to the current situation. Nevertheless, this week's market activity is expected to be quieter. The presence of these factors continues to cause cast a shadow over the gold price for a longer term. For the remainder of this week, traders should keep an eye on the U.S. labor market data on Thursday as it relates to the survey wake of the September non-farm payrolls figure. Speeches delivered by the Fed and ECB can also be important. These two factors can closely influence the US dollar and gold prices indirectly. So that's all for this week. Stay tuned with Pepperstone.